the fact that gold itself may be the safest alternative relative to U.S. Treasuries. And as we see that evolving, it's going to drive the demand for gold, and gold will likely get into what I think would be a secular move. A secular move in gold to the upside tends to drive other commodities. And so I get very bullish in all this because I think those businesses that hold resources in metals and so forth are just not priced accordingly. And so those things are probably going to be the ones that will perform the best.
Tavi Costa, a member and macro strategist at Crescat Capital, is closely monitoring the potential macroeconomic shift and its implications for the current portfolio. In light of recent developments, Tavi holds an optimistic outlook on investments in businesses related to natural resources and metals, particularly gold. The recent uptick in gold prices has been due to a slight retreat in the value of the US dollar and bond yields, driven by investors' digestion of the Federal Reserve's still-hawkish stance. Additionally, the 10-year Treasury yields have pulled back from their 16-year highs. One notable concern Tavi raises is the accelerating annual inflation rate in the United States, which has risen for the second consecutive month, reaching 3.7% in August, surpassing market expectations. Projections suggest that inflation may reach 3.5% by the end of the current quarter. Tavi attributes this trend to the onset of a potential inflationary period, where prices are expected to trend higher over the next decade, though not necessarily skyrocketing. While the U.S. Central Bank has maintained its current interest rates this week, there is the possibility of a 25 basis point rate hike before the end of the year, according to the Federal Reserve's updated quarterly projections. Tavi Costa emphasizes the potential impact of a major economic shock on the government and the Federal Reserve, anticipating a substantial response in the form of stimulus measures like increased government spending and lowered interest rates, which have the potential to drive up the prices of hard assets such as gold. Before diving into Tavi Costa's insightful interview, subscribe to our channel and give this video a big thumbs up.
There's so many charts where you see those breaks of correlations or divergences in lines, or either macro assets or indicators, where there's a very long list of indicators basically pointing to a recession. And then there are important changes in terms of how assets have behaved in times when, let's say, treasuries have been under pressure. You would expect that to reflect in the gold market, but gold market has been incredibly resilient, especially relative to real rates. And it's either because we're yet to see the gold market reflect much lower prices, or it's a significant change in the macro regime. And I am a believer that that's the case. It's that we're starting an inflationary era. And when I say inflationary era, doesn't mean necessarily that inflation will always be on the rise. It just means that it will be higher than historical standards, regardless if it is 3-4%. Throughout the next 10 years in average. And I think that will be the case because the underlying factors that we have right now are very entrenched in the economy. The chronic underinvestments in natural resources, the deglobalization trends are continuing to be very significant. And you have the fiscal stimulus still very inflationary, and the inequality issues kind of creating this need for workers to demand higher wages and salaries, when social programs are also going to be a large part of this too. So there are all these things, and I think if you think about the debates happening in markets right now, is that some folks believe that this upper move in inflation and the downward move that we've seen recently is just sort of a cyclical kind of change that was not as fundamental as or structural as some macro thinkers believe. And I'm in the camp that these changes are very structural in their nature, and that is the reason why we're seeing some different behaviors in asset classes. And again, it's not doom and gloom or anything like that, but it will create different types of opportunities, and it will also change the leadership. The traditional way of doing things is you have a recession every 5 years or so, give it or take. every time there's a recession, what you do is you increase your allocation on fixed income. And there is a period where inflation rises right before the crisis, then inflation starts to decelerate, and then there is an economic shock. The Fed has to cut interest rates. Treasuries on the long end actually move a lot higher. And that sort of framework has worked so well in the last 2 to 3 kind of decades, but I don't think they're going to work as well. And you buy the dollar and so forth. I think that during more stagflationary periods, gold is actually served very well as a defensive asset. And I'm more and more of a believer that that's going to be the case, and that's because eventually the market begins to price in that if there is any sort of shock in the economy, ultimately what we see is very, very large amounts of stimulative packages from the government and from the Fed that it eventually drives hard assets a lot higher. So that to me is a risk.
In 2022, the yellow metal, gold, enjoyed an exceptional year, witnessing a surge in demand that reached levels not seen in over a decade. What's particularly striking is the substantial interest displayed by central banks around the world, who collectively acquired a remarkable $70 billion worth of gold, a buying spree unmatched in the past 73 years. Notably, the People's Bank of China emerged as a prominent player in this gold acquisition game. In July, it took the lead as the largest buyer, bolstering its holdings with an impressive addition of 23 tons of gold. This marked the 9th consecutive month of gold purchases by the Chinese central bank. Tavi Costa offers a compelling explanation. It appears that central banks aren't primarily motivated by concerns about financial losses. Instead, they are turning to gold as a safe and dependable asset to fortify their reserves. Interestingly, gold is increasingly viewed as an attractive investment option thanks to its perceived safety when compared to U.S. government bonds. Now, let's move towards the interview as Tavi explains. In an era marked by economic uncertainties and fluctuating markets, gold emerges as a beacon of stability and dependability.
You're kind of seeing two forces at once in the gold market. One is central banks buying gold for other reasons, not because they're worried about downside. They're worried about owning a neutral asset and improving and enhancing the quality of their international reserves. So they are buying gold for other reasons. And then you have 60-40 portfolios that are now ignoring the metal, but will likely be buying that when they realize, first of all, the changing market correlations, and number two, the fact that gold itself may be the safest alternative relative to U.S. Treasuries. And as we see that evolving, it's going to drive the demand for gold, and gold will likely get into what I think would be a secular move. A secular move in gold to the upside tends to drive other commodities. And so I get very bullish in all this because I think those businesses that hold resources in metals and so forth are just not priced accordingly. And so those things are probably going to be the ones that will perform the best. I mean, I can speak for my portfolio, and we've done very well just by doing that, and not necessarily buying GDX and all the kind of more traditional ETFs inside of the metals and mining space, but rather looking for kind of a way to apply an activist role into companies that we thought were inefficiently mispriced. And there are no shortage of those things because right now everything is priced for failure. So you have a very high quality asset priced the same way as a poorly driven asset. And so you can take a long-term mentality and mindset of creating a strategy of really accumulating those high quality companies over time and creating a lot of value. So, to me, that's a much more attractive way of investing than conventionally just buying technology companies and other things that have done so well that people think and assume are going to do, continue to do that well over the next 5 to 10 years. And whatever worked in the last 5 years is unlikely to work in the next 5 years. And that applies to a decade long as well.
Considering the concerns surrounding inflation and the state of the U.S. economy, how do you envision gold's role evolving as a hedge against economic uncertainties and potential currency devaluation in the near future? If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Surprisingly, around 70% of our viewers haven't subscribed yet. We're aiming to reach 3,000 subscribers in the next 2 weeks, and your support could make a big difference. Thank you for being a part of our community.